Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Thursday, February the 26th, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story that's really captured everyone's attention is Nvidia's earnings report. They absolutely crushed expectations with revenue of $39.3 billion, up 78% year over year, and earnings per share of 89 cents. But what's really interesting here is CEO Jensen Huang's commentary. He came out swinging, essentially telling the market it got it wrong about AI being a threat to software companies. We'd seen software stocks under significant pressure heading into these results, with investors worried that AI would cannibalize traditional software business models. Huang's reassurance that AI demand remains robust and that software companies will actually benefit from this transition helped lift sentiment across the entire tech sector. We saw the stock rally in after-hours trading, and that positive momentum carried over into Asian tech stocks overnight.
That's a major development. How are you reading the market's interpretation of these results beyond just the immediate relief rally?
While Nvidia's results provided broad relief for the tech sector, not all software and tech names are benefiting equally. Companies like Salesforce actually saw their shares sink despite committing $50 billion to buybacks because their guidance was mixed. Meanwhile, we're seeing some interesting divergence where certain names like Vertiv and West Pharmaceutical Services are actually bucking the broader trend. Vertiv is benefiting from the data center boom that Nvidia's results reinforce, while West Pharma has strong hedge fund interest supporting it. The key takeaway for traders is that this isn't a rising tide lifting all boats situation. You need to be selective and focus on companies with direct exposure to AI infrastructure build-out, or those with strong fundamental catalysts independent of the broader narrative. The market is clearly differentiating between AI winners and companies just riding the hype.
Steve, let's get into the economic numbers. What's the picture looking like this week?
Thanks, Robert. Looking at what we've seen earlier this week, we had factory orders released on February 23rd. That report came in at 0.7%, which actually beat the forecast of 0.5% and was down from the previous reading of 2.7%. It's a low to medium volatility indicator, but it does give us some insight into manufacturing demand trends. The beat suggests there's still some resilience in the industrial sector, despite the deceleration from the prior month's strong 2.7% reading. Now, for today, Thursday, February 26th, we're getting the weekly initial jobless claims report. This is a high-frequency employment indicator that markets watch closely. Last week's reading came in at 231,000, which was higher than the forecast of 212,000 and up from the prior week's 209,000. That uptick caught some attention, so traders will be watching today's release to see if it was a one-off or the start of a trend. Any significant move higher could signal softening in the labor market, which would be dovish for Fed policy. Looking ahead to tomorrow, Friday, February 27th, we're getting the Producer Price Index, which is a high volatility inflation indicator. The forecast is for 0.3%, down from the previous reading of 0.5%. This will be important because it gives us insight into pipeline inflation pressures before they hit consumers. If we see PPI come in hotter than expected, it could reignite concerns about the Fed's ability to cut rates this year, while a cooler reading would support the dovish narrative.
Thanks for that overview, Steve. Now, Lizzie, let's turn to our stock of the day. We're looking at Intuitive Surgical, ticker ISRG. This is a name that's been under pressure recently. Walk us through what's happening here.
Absolutely, Robert. Intuitive Surgical is the dominant leader in robotic-assisted surgery, primarily known for their Da Vinci surgical system. Currently trading at $506.17, the stock is down nearly 13% over the past year and about 10% year to date. What's interesting is that this weakness seems to be more about valuation compression and sector rotation rather than fundamental deterioration. The company continues to execute well on their DV5 system rollout, which is their next-generation platform, and procedure volumes are growing. But here's the challenge. The stock trades at a PE ratio of 64.48, which is significantly above market averages. The forward PE is 44.25, suggesting the market expects about 31% earnings growth. But at these multiples, there's very little room for error. The stock has fallen from its 52-week high of $603.88 down to current levels, and it's about 16% off those highs.
So we're looking at a high-quality company that's gotten cheaper, but it's still expensive on an absolute basis. What's the bull case here for someone considering buying this dip?
The bull case centers on several factors. First, analysts have a consensus price target of $609.82, which represents about 20% upside from current levels. The average recommendation is a buy with a rating of 3.8 out of 5. The company has a massive competitive moat built on technology, training infrastructure that's embedded in medical residency programs, and regulatory clearances that create high barriers to entry. The DV5 platform cycle should drive replacement demand from their existing installed base, and they're expanding into new surgical specialties and geographies. There's also the broader secular trend of automation in healthcare, and Nvidia's CEO recently made comments about robotics having a ChatGPT moment, which creates positive sentiment for the space. Simply Wallsint has a fair value estimate of $611.82, suggesting the stock is undervalued at current levels. For long-term growth investors with a 12 to 24-month horizon, this pullback could represent an opportunity to establish positions in a best-in-class franchise.
But there are risks here too. What should investors be watching out for?
The biggest risk is valuation. At 64 times earnings, if growth disappoints or if interest rates rise, this stock is vulnerable to further multiple compression. We're also seeing competition intensifying from players like Medtronic, Johnson & Johnson, and Stryker, who are all targeting the robotic surgery market. That could pressure both market share and pricing power. There are also near-term margin pressures from tariffs under the current administration that could impact manufacturing costs. And finally, any changes to healthcare policy or reimbursement rates could affect the economics of adoption for hospitals. My take is this: if you're a growth-oriented investor willing to accept volatility, the current weakness offers a reasonable entry point. But I'd consider dollar cost averaging rather than putting all your capital to work at once. The year-end target of around $590 to $610 implies 16 to 20% upside, which is solid, but you need conviction in the long-term story because the near term could remain choppy.
Good analysis. Now let's shift to crypto. Lizzie, what are you seeing in the digital asset markets heading into next week?
The crypto market is showing some solid bullish momentum right now. Bitcoin has climbed back above $68,500, benefiting from the rebound in risk assets and those strong Nvidia earnings we discussed earlier. What's encouraging is we're seeing indicators suggesting a potential bottom is forming. There's been what's called a mining capitulation period that appears to be ending, which historically signals price bottoms. We're also seeing growing institutional interest with players like Jane Street and Anchorage Digital making strategic Bitcoin-related moves. The sentiment is bullish, and analysts are eyeing a potential test of new all-time highs in the near term. Bitcoin is also showing some interesting divergence from gold, with analysis suggesting this rotation could signal significant upside. For Ethereum, we're seeing bullish momentum as well. Vitalik Buterin recently shared a 4-year roadmap for making Ethereum faster and more quantum resistant, which is generating positive sentiment. The Ethereum Foundation is also increasing support for DeFi protocols, and we saw ETHE Zilla rebrand to Forum Markets with a 13% price jump. Ethereum could potentially outperform Bitcoin in the short term given these catalysts.
And what about Solana? That seems to be getting a lot of attention lately.
Solana is actually leading the crypto recovery with a 10% gain recently, and analysts are eyeing a potential move toward $100 per SOL. The ecosystem continues to show strong development activity, with a Solana-based prediction market protocol called TBD raising $3 million. We're seeing high transaction volumes and activity on the network. The overall sentiment across all 3 major cryptocurrencies is bullish for next week. The key factors supporting this are the broader risk-on environment following strong earnings data, institutional players increasing their exposure, and on-chain metrics suggesting we may have found a bottom. However, investors should remain aware that crypto is still vulnerable to macroeconomic headwinds and regulatory uncertainty. Volatility should be expected, but the near-term trend appears positive. For those looking to add exposure, dollar cost averaging remains the prudent approach rather than trying to time a perfect entry.
Well, that wraps up today's episode of The Morning Bell. We've covered a lot of ground from Nvidia's strong earnings and the implications for tech stocks, to the economic calendar with PPI coming tomorrow, our deep dive on Intuitive Surgical, and the bullish momentum building in crypto markets. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to The Morning Bell so you don't miss our daily market insights. I'm Robert, and we'll see you tomorrow morning.